So I am just going to get started with the conversation. I'm going to upload my screen and then my slides, and then we can talk through those. Because I believe that I've got some very important talking points that's going to be beneficial to every single person here. Now, generally speaking, when we hear the term investment, again, the thinking that we have around that is money coming into a business. However, how that money behaves differs from type of business to type of business. So, for example, Rachel talked about working in a CIC supporting entrepreneurs. How funding works within the realm of CICs is quite different from how it will work within the realms of a typical business. But in any case, I will get started with the core of why we are here and then try to break it down on a slide by slide basis. Can everybody or can somebody just confirm that you can see my screen and you can see that fully and nicely?
Yes.
Fabulous. So let's get the show started. Now, like I said to you earlier, my name is Davis, and what I do on a day-to-day basis is help entrepreneurs raise capital. I run a company called Pitch Hub, and we work with founders that are looking to raise capital. We help them, we educate them, first of all. We help them prepare for the requirement of an investor. We help them implement those things. So we develop and create all those tools and resources and documents that you would need when you're fundraising. And then we introduce our founders to investors, signpost them to funding sources and whatnot. For me, it's been a very interesting journey. I've been an entrepreneur all my life as well. And a lot of the things that I'm going to share with you today are things that have evolved out of the experiences that I've had as an entrepreneur supporting other entrepreneurs. My first successful company was one that I launched in 2015. It's called Enterprise Hill. It's boring business. It's an accounting firm. However, the difference there was we didn't set up because we wanted to do accounting and compliance for businesses. We set up because we wanted to help businesses grow. Finance and numbers were just the tools that we needed. So that was our tool of specialty with which we analyzed the business, identified the opportunities, and charted a course for growth. Started that business in 2015. I'm originally Nigerian. I was in Nigeria at the time. And just based off the strength of the work that we did on that business, I won Nigeria's version of The Apprentice. It's called The Next Titan. That's what this logo here is for. And then did that. And based off of that, we're able to do a whole lot more work with lots of businesses. I got recognized by Forbes for some of the work that we did. But one of the things that I very quickly discovered along that journey of supporting entrepreneurs is the fact that doing the numbers and having the strategies is just not enough to achieve growth if you do not have the resources to implement. So, one of the things we would discover very rapidly along our journey was the founders and clients that we were working with kept coming back to us and saying, Davis, yeah, this strategy is all well and good, but we need to finance it. Organic growth is not just enough. And that's what led me into the world of fundraising. And the more I did it, the more I realized the massive gulf that seems to exist between entrepreneurs that are raising capital, most especially first time fundraisers, so entrepreneurs who are raising their first round of structured capital. There's a massive gulf between those people and the investors that actually put money into businesses. And it's not a gulf of anything else but just a gulf of understanding. There's a massive information asymmetry. So essentially, investors that are looking to put money into businesses are looking for certain things. And founders that are looking to get access to that money can't seem to understand what those certain things are. And so I've just made it my life's mission ever since that point to help bridge that gap and help founders realize what they need to do, help connect them to investors, and help getting funding flowing into businesses to power growth across businesses. And over the last 3 years alone, we've supported the raise of over £14 million in funding. Anyways, let's get into it because one of the things that creates that gulf is this misconception that most founders have every time they hear fundraising that, oh, I need to convince investors. Now, please pay attention to this because it's very important. If we do not have this mindset shift, we would not have the financial shift. Raising capital is not about convincing investors. And I know that that sounds so counterintuitive, right? But it is true because even I believed from the start that, oh, I just need to make this special people called investors that seem to hold all the power in their hands. I just need to get them to like me and like my business enough to them for them to say, oh, you know what, we will bless you with the gift of our money. That's what I thought it was. And so I thought, all I had to do is design the best pitch deck and design the best financial model or something of that nature. And if I did that, it would be a great start. Then the next thing I would do is make sure that, I was only working on things that were super innovative. Try to get into the technology world because it seemed from what we saw in the media that investors only funded groundbreaking innovation. And they do fund groundbreaking innovation, but not only, right? The other thing I assumed was that, it was a hit or miss game. Like you put your best foot forward, design the best decks you can, and you hope that somebody actually puts capital into your business. Well, wrong. What I have discovered over approximately 6, 7 years of focusing extensively on fundraising and helping founders raise capital is that your job as a founder is not to convince, your job is to attract. Investors are not looking for smart entrepreneurs that will pull the wool over their eyes, that would create this beautiful facade of the best business ever, only for them to get in and look and find, a rotten apple at the back end. That's not what investors are looking for. They're not excited by this person's trying to convince me. However, when they see an opportunity that looks attractive, and we're going to talk about the things that determine that attractiveness in a bit. But when investors identify an opportunity that is attractive, then they come flocking to it. I'm sure that you must have seen snippets of this in the news if you follow news around fundraising, where on the one hand, there seem to be a lot of founders that cannot seem to access capital. And on the other hand, there seem to be a few founders that everybody wants to put money into, right? What is creating that scenario of investors flocking to one business is because, first of all, there is something called a herd mentality that exists with investors. Once an investor invests, a significant or well-reputed investor invests in a business, a lot of other investors just sit up and take notice because they believe that, no, for that guy to invest, they must see something really special. I don't want to miss the opportunity, so I'm going to jump on it as well. So a herd mentality happened in the world of investing on the one hand. But one of the crucial things besides that is that the opportunity must be right. So for me, the discovery that I made along my journey working with founders is, first of all, the thing that makes your business attractive is that you have what we call an investable proposition. So investability is the core. And I'm going to share with you what makes up an investable business in a second. So investability is the core was one of the very, very transformative discoveries that I made, because then it began to shift the paradigm that it's not just about beautiful looking document or well polished pitches or oratory skills to deliver convincing narratives. That's not what it's about. It's about having a business that is investable. We're going to get into the core of that because when you take a look at all the many businesses that have successfully raised capital, the one thing that is common to them all was that they all exhibited the signs of investability within them, right? The second thing to mention is it's not just about the most innovative ideas. Investors actually put their money into what we call compelling visions. The vision of what the business is looking to accomplish must be compelling enough for the investor to say, you know what, I want to be a part of this journey. For example, one of the very common errors that I see with startup entrepreneurs is when we have conversations around, okay, so what is your mission? What are you looking to accomplish? You hear people say things like, oh, we want to become, the leader in our industry. Well, that is all well and good for you, but who cares? besides you. When you become the leader of the industry, the only person that really, really cares about that is you. But if you literally, and that's not to say you shouldn't aim to become the leader in your industry. What I'm saying is just the narrative, how you present the narrative, how you present the vision. As opposed to say, for example, oh, we want to become the leader of our industry. You could literally just say, we want to make sure that every customer, whatever your customer group is able to achieve XYZ. Something that more people can get behind, something that is not just about you, your company, and what you accomplish. Things of that nature. I mean, popular example that I'm sure most people can relate with is Elon Musk, who keeps talking about making life multiplanetary. We want to go to Mars, right? Now, to an investor, the question is, why should I be putting my money in this? Well, I'll tell you why. It's not only because of the idea of getting to Mars, because that in itself is very powerful, but because in the achievement of that vision, there are so many other opportunities that will be unlocked. For example, the technology the technological innovation that it would take to build all the rockets and the resources that would make life sustainable on Mars, all of those technologies in themselves can be commercialized and become money spinning businesses by themselves. So ultimately, when investors are evaluating a proposition, what they're looking for is not just the technicalities of the innovation or the beauty in what you're doing. It is, where is this business going and can we be a part of it? And then the last thing to mention is, it's not a lottery. Raising capital is a methodical, repeatable process. It's not a lottery. If you know exactly what to look for and you know exactly what to do, you will get the results that you need. Unfortunately, most entrepreneurs, when it comes to the raising capital, feel very confused because of the multiplicity of ideas that are out there. And there's no shortage of blogs that tell you, these are the 10 slides you must have in a pitch deck in order to convince an investor, or, do these three things and you will attract capital, things of that nature. There's a lot of conflicting ideas. But my mission today would be to give you a very simple framework that, if you follow it, will lead you to absolute clarity around where you are and what you need to do, and confidence in terms of how you approach the fundraising conversation. And that framework is what we call the PASTA framework. So this is a framework that I coined based off of tried and tested principles of of engagement with clients and engagement with investors. So what is this PASTA framework? Well, PASTA is an acronym. I just chose the word pasta because, well, first of all, if pasta is a beautiful thing, and then it's a memorable thing. So if you don't like pasta, I'm sorry. But yeah, what is this framework? So the first word is path. If you want to raise capital, let me just put it to you bluntly. The very first piece of work you must do is identify the growth blueprint for your business. Let me tell you what I mean by that. In order to raise capital, you must ask yourself the question, what are we raising capital for? The answer to that is your growth blueprint. So the blueprint would include the growth objective. So what is the specific thing we're looking to accomplish as a business? And then the growth plan. What is it? What are the things that we're going to do? What are the tactical moves, the ideas that we're going to implement to actually achieve that? So that is the first thing we're going to dive into today. So the path. The second thing is the asset. The asset is the business, the investable business. So the first thing to consider is, where is the direction of travel? The second thing to consider is, what vehicle are we going in? So what is the asset? What is the business? This asset that an investor is putting their money into, is it the right type of asset? Is it an investable asset? That's the question you need to ask under that next step. And then the third part then is the strategy. So the strategy here refers to the fundraising setup. So how are we going to set up to successfully raise the capital that we need? Then the fourth thing is the tool set or the tools. And the tools essentially refer to the resources and the document and whatnot that you're going to require to engage the required type of funding that you're going to be engaging with. And then the last but not the least is activation, which is what are the steps that you need to take to actually bring that vision of raising capital to life. You can literally take this framework as the table of content for the conversations that we're going to have today. We do not have enough time to cover in depth every single thing here. But what I've decided to do is, at least on each of the stages, the path, asset, strategy, tool set, activation, I am going to share a couple of core concepts and core ideas, enough for us to actually understand and take action. And then that way we can identify where we're at as a business and we can begin to take constructive action. Does that sound like a good plan? Are we excited to go ahead? I can hear you, so just give me thumbs up. Yeah, beautiful, beautiful, beautiful. Thank you very much. So let's get the show on the road. What is this path that was going on and on about earlier? Now, when you want to raise capital as a founder, oftentimes there are so many reasons that prompt that need. So sometimes it is we find out that we have a cash flow crunch, or we find out that, oh, we need to hire people, but we don't have the money, or there are opportunities that we have observed in the market that we cannot effectively take advantage of. All these kind of things happen. However, there is only one reason why anybody should raise capital. And the reason is you raise capital to execute a growth strategy. So whatever your reasons for wanting to raise capital, the question you need to ask yourself is, number one, is this a growth move? So is this a growth move that we're trying to raise capital for? Is it a coordinated move? Do we know the exact objective? Do we know the exact plan? Because when we say you raise capital to execute a growth strategy, you cannot get the capital if you do not have an execution plan. You cannot have an execution plan if you do not have the strategy that you're trying to execute or the growth objective you're trying to execute for. So, first of all, you must set a growth objective. Now, let me double click on this for a second because I believe that this is very simple, but it is very important. I have not met one single entrepreneur in my 12 years of being an entrepreneur and working with entrepreneurs. I have not met one single entrepreneur that doesn't want to grow their business. Is there anybody here who doesn't want to grow their business? If you don't want to grow your business, you're probably not going to be in this room. But I have met so many entrepreneurs that want to grow their business, but do not even have a clear picture of what growth looks like. You see, growth is a perpetual thing for every business. Even the biggest businesses in the world, right, still want to grow. Marks and Spencer still wants to grow. Amazon still wants to grow. Uber still wants to grow. Everybody still wants to grow. Growth is perpetual. It never ends. So one of the things that you must do when you're fundraising is to ask yourself the crucial question. Yes, I know we want to grow, but what is the next tranche of growth? Or what is the next growth sprint that we're on? My favorite strategy is always to break growth into 3-year chunks. Why 3 years, you may ask? It is not too far into the future that it becomes intangible. And it is not too near into today that it becomes improbable. 3 years is about enough time to achieve anything you want to achieve within your business. So, what I would encourage you as a first action point from today's conversation is actually describe in very simple details what does growth look like for our business. Here are some parameters that can help you simplify that work. Pen it into a 3-year objective and pen it into a revenue objective. Why revenue? Because revenue is a true indicator of growth. And everything that you have considered to be growth in your business, everything can find expression in more revenue. If you have more money coming into your business, you can hire more staff. You can expand your manufacturing base. You can expand your locations. You can serve customers internationally. You can develop, more innovations. If you have money coming in, more revenue, every other goal finds expression in that. So what is your growth strategy for the next 3 years? So over the next 3 years, we want to become a £300,000 a year turnover business. That is a growth objective. Now, it's not the presentation of it is simple, but there is a lot of work that goes into that presentation because you have to think through, okay, where are we right now? How do we get there? What is the objective? What is it that is going to mean for our business if we're doing this kind of numbers? But ultimately, this is the first principle in defining your path. You must have a clear growth strategy that you're executing. The reason as well is because investors are not just going to give you money simply because you need it. And as simple as that sounds, a lot of entrepreneurs literally just adopt this approach. So you go, I want some money. We need money in our business. Let's go into the fundraising market. And then the investor says, why are you raising capital? Because we need it. They're not just going to give you money because you need it, because investors, their business, they are in the business of multiplying money. Right? So for them, it's not just about who needs money, it's about who can take in our capital into their operations, blow up their operations in a way that blows up our money. I don't mean blow up, destroy. I mean blow up and make it bigger. Right? So the investors are thinking, who is going to take this money into their business and by so doing make their business bigger and make our money bigger? That's what they're thinking about. As such, what that means for you as an entrepreneur is regardless of your growth requirement, regardless of the things that you need the capital for or the things that are driving your need for money, you must learn to be able to frame it in a way that also align with investor objectives. And we're going to talk about that in a second, but just so that I fully encapsulate this growth blueprint that I've been talking about and this growth objective and this growth strategy, this is what it contains. Number one, you must have absolute clarity around your business model, meaning this is how we operate as a business, this is how we find our customers, and this is how we make money. That's what your business model clarity means. If you do not have that clarity, you would not even understand how to begin to plot growth for your business. So the first thing is, this is how we make money. So we operate this way, we get customers this way, and then we make money this way. That's step number one. Step number two then is, because this is how we operate, this is the next thing we want to achieve because of where we currently are at. So for example, we have only just started this business 14 months ago, and currently we have 12 active paying customers, collectively contributing into our business £10,000 in sales on a monthly basis. Our objective over the next 3 years is to go from a £10,000 a month business to a £50,000 a month business. That, ladies and gentlemen, is a strategic objective. The next thing that then follows that is, okay, great. We want to go from £10,000 a month to a £50,000 a month. How do we execute that? What are we going to do to actually make that move? Is it about investing in new technology? Is it about acquiring new customers? Is it about developing new product? Is it about developing new distribution infrastructure? Is it about pursuing new market verticals? What is the execution plan? You have no business discussing with an investor if you do not know what your business model is, if you do not know what your strategic objective is, if you do not know how you're going to execute that objective. An investor is not going to fashion that for you. You've got to fashion that for yourself. And once you've done that, you then go figure out the cost. So do an estimated cost. Do a bit of research to find out what it's going to cost you to execute that plan. So for example, executing your plan might require you hiring two new people that are going to implement a social media strategy that would enable you acquire new customers, or what have you. It might be anything, but whatever that is, you have to then put a cost to all of it. So when we talk about the first step being determining the path, which is the growth vision, the growth blueprint, what we're saying is what you should do is be clear around how your business works, have a specific objective that is the next tranche of growth that the money is coming to fund, have a plan as to how that growth is going to happen, and have a rough idea of what it's going to cost to actually implement that growth, because that then begins to form the basis for the money that you're looking for. Does that make sense? All right. So let's move on to the second thing, which is the asset in question. I use the word asset because when an investor looks at your business, they see an asset. Investing in businesses or in startups or in new innovation is an asset class for investor. So, generally speaking, let's dial back a bit. Who are investors? Investors are people that have got excess capital or that have got access to capital, and their job is to put that capital into resources that will, number one, preserve that capital, number two, grow that capital. Those are the things that investors care about. They have access to more money than they ever could need, either on a personal level or an institutional level. And so what they want to do is they don't want that capital to erode over time, because if they just leave the money lying in the bank, inflation is going to destroy it. So what they want to do is take that money and put it into a vehicle that would keep the value of that money and even grow the value of that money. As a result, they look for what we call assets to invest in. It could be real estate, it could be stock market, it could be a business. So your business is an asset class. Some investors don't invest in businesses, they invest in precious metals. Some people invest in the stock market, some people invest in the real estate market, some people invest in businesses. And why do investors favor businesses? Because business is the investment asset that gives you the biggest chance of exponential growth. Meaning, business is where you can ever make the most money, more than any other type of asset class. It's a very risky vehicle, but it also promises the biggest returns. So, for those investors that favor putting their money into a business, the question we must ask as founders that are looking to attract what they have, which is their capital, the question that we need to ask is, what is it that these people want in return? What are they really looking for? What makes them choose business A as opposed to business B? I'm going to give you the secret. Please pay attention to this. A lot of people think investors are all about getting returns on investment. And that is not a lie. Return on investment is crucial for every single type of funder. But it's not the number one thing. The number one thing that every investor looks for in a business is the security of their capital. Is my money safe in this business? That is the first subconscious consideration every investor makes. I use the word investors very loosely, which is the reason why on my slide I've called it funders, because this could be equity investors, they could be debt providers. So it could be a bank giving a debt, or British Business Bank, or any of these debt providers that we have across the country, public or private. Or it could even be a government providing grant, or an organization, institution providing a grant. Every time anybody is looking to put money into a business, the first question they ask is our money safe in this vehicle? Now, safety or security means different things depending on if it's an equity or debt or grant, right? But ultimately, what all those investors are looking for is this. If we put our money in here, will it preserve value? Will our value be preserved? Now, it is only when they've satisfied the fact that, this is a good vehicle, we're most likely not going to lose the money. Even if we don't make money, at least we would just break even or stay at par, things of that nature. Once they've satisfied that, it's only then that they then go on to the criteria of, will I make more money? Because there's no point thinking about how much money I am going to make if I am not even sure that the ones I am putting in is going to be safe. Investors don't want to lose their money. Remember, their money is their stock in trade. They are in the business of using money to make money, more money. So when they lose their capital, when they lose their asset, their business have suffered a significant loss. And so they don't want that to happen. So when they are evaluating your business, consciously or subconsciously, they are evaluating the security of their capital in your business and the efficacy of your business in keeping their capital. And that's why that thing that I mentioned earlier, investability, matters a lot. We're going to double click on that in a second. But it's not just two things investors think about, it's three. So they think about the security of their capital, they think about the return on investment, they also think about strategic alignment. So an investor goes, is my money safe in this vehicle? Yes, I think it's a great business. I think that they're very solid proposition. The chances of losing money here is very low. Great. Now, the second question, we will make more money here. Yes, based on the vision that they have and whatnot, it looks like it's a great market trajectory. The timing is right or whatnot. This is a great one. And then the third question they ask themselves before ever putting money in is, does this align with our strategic vision as an investor? So, for example, an investor could have all the money in the world, but they could say to themselves, we only invest in businesses that are shaping the future of our environment. If you are building a business in healthcare, you're probably not their target. You don't fit into their strategic thesis. If you're a fintech business, you don't have that strategic alignment with them. Some investors could come up and say, we only invest in businesses in Cumbria. If I am based in Essex or Birmingham, right? I don't fit. Even if they see that my business is a safe investment, they see that they're going to make returns. If I don't fit into whatever is described in their thesis. So thesis is the word that is used to describe the modus operandi for investors. So the guidelines that investors live by. I invest in this type of business, in this type of sector, in this type of industry, and the identifiers could be anything. It could be location, it could be industry, it could be sector, it could be a mission, it could be a social value, it could be anything. So ultimately, every funder wants security of capital, return on investment, and strategic alignment. So what must you do in return as a founder to ensure that you align with this? You need to de-risk your business. That will help show that your business is safe. You need to demonstrate return potential. That would help show that your business has a massive opportunity that I can take advantage of that will return a lot of value into the business and to the investors. And you need to align your story with the interest of the investors. These are the things that you need to do as a founder. So when we talk about the asset as a business, this is what we're asking you to do. De-risking your business is all about the business. Demonstrating return potential is all about the opportunity. Aligning your story is all about you, the founder, and the team that you've put around you. Hence the reason why successfully raising capital falls into two categories. First is investability, second is investment readiness. When I talk about the PASTA framework, strategy and tool set, that's investment readiness. Asset, that's investability. What is investability? The investability bot means, number one, you are investable if you have a viable business, if you have a sizable opportunity, and you have a backable team. If you've got these three things in your business, fundamentally, you are investable. The next challenge you then have to navigate is how do we present our proposition in the right way to the right investors? That's what investment readiness as a discipline concerns itself about. But fundamentally, this is the first criteria you must check off. Do we have a viable business? Do we have a sizable opportunity? And do we have a backable team? So I am going to take a bit of time to explain really quickly each of these three things. With viable business, I am going to lean into my financial roots. So I've always numbers have always been for me a critical tool for business growth and business strategy. So what I'm going to do to explain a viable business to you is take you back to the basics. For those of you who might be accountants in the room, you might want to forgive me for this one because I'm going to bore you for a bit. So in order to explain viable business, I'm going to talk to you very quickly about how business finance works. So in any business, money flows in and out. Everybody knows that. And there are three areas of a business that money operates in. You have the financing activities, investing activities, and you have operating activities. Those are the three areas of a business. Financing activity concerns itself with how the business gets the money that it uses to operate. So what we're talking about today, investment. Investing activities focuses on how the business utilizes those chunks of money to build up competencies that it needs to operate. Operating activities focuses on the day-to-day running of that business. So let's see how business finance works across these three dimensions. So the first thing that happens is that a business gets capital. So that capital could be the money that the founders put into the business or that investors put into the business or debt that you've gotten. Now, from that capital, you take some of that money and then you put it into assets. So with the capital you've gotten, you buy a piece of property to operate from, you buy some machinery, you do all those kind of things. So you make some investment, you buy some equipment, whatnot. And then you take the rest of the money and then you put it into things that enable you to operate. So you spend direct cost on creating your goods and your services or, buying the products that you're selling. You run overhead costs in terms of running the day-to-day business. You're paying staff, you're paying rent, you're paying for internet and telephone, you're traveling, whatnot. Those are overhead. And then you spend money on acquiring customers. So marketing, customer acquisition and whatnot. So when you spend money on the operating activities, it's going into cost of getting the goods in the first place. That's what direct costs are. Cost of running the business. That's what overheads are. And cost of acquiring customers. When you spend money on assets and all these other types of costs, the resulting effect is that the business then generates income. And when you take out the cost from the income, you have profit. Now, this is the rule that your profits must adhere to. Your profit must be enough to pay back the cost of capital. So if you borrowed money, you must be able to pay back the cost of borrowing that money, whether that be interest to the bank or dividends to investors or whatnot. You must have enough in your profit to at least satisfy the cost of getting capital, and you must have enough in your profit to reinvest into the business. This is the cyclical flow of money in a business. This is what a viable business looks like. If your business is not doing this flow just yet, investment will be challenging. It's not impossible, but it will be challenging. If your business is already doing this flow, like you're getting capital, you're spending money on these things, is returning profit, and you are reinvesting the money into the business to grow it gradually. If you're already doing this flow, you are already on your way. Is this landing? Is this making sense? Everyone good? Good. Fabulous. Now, if this engine here is broken, raising capital is not the solution. I'm sorry to break it to you. You don't raise capital for a broken engine, because if you do, you only make your problems more expensive. Right? What you want to do is, first of all, fix the engine, because fixing this engine is a question of what we talked about earlier, your business model. Are we operating in the right way? Do we have a clear distribution model of how we get customers? Our customers, is our pricing correct? Our customers, happy with our revenue model? Are we able to monetize this business effectively? These are fundamental business questions that you have to answer as an entrepreneur. You don't need an investor to answer those questions. So if this engine is broken, you need to fix that first. Right now, if you fix that engine, then we can go to the second thing, which is sizable opportunity. Now, the idea of sizable opportunity is you want to demonstrate that there is a massive opportunity that your business can take advantage of, and that opportunity must be sizable enough for the investor's appetite as well, right? So what I mean by that is, for example, if you are looking to raise, I actually have an example on the screen which I'll share. We talk about investors a lot, and by the way, when we talk about the strategy, the fundraising setup, I will talk about the types of investment and types of money. But let me just very quickly give you an example of what I mean by sizable opportunity. VCs are venture capital organizations. So venture capital firms are money managers. They invest money into businesses. A lot of them with the sole aim of being able to multiply that investment at least 10 times. So VCs are generally known to want a 10x return. That's the terminology that is used. But essentially what that means is we want a 10 times return on our money. So if a venture capital firm, for example, remember what I'm explaining, sizable opportunity. This is just a simple illustration. If a venture capital firm invests £500,000 in your business, and they took 20% equity in the business, meaning they took 20% of the ownership of the business. Now, in terms of sizable opportunity, this is what these numbers mean. If somebody took 20% of the business for 500,000, it means that the entire business is worth 2.5 million, right? But before we even get there, if I took 20% and my objective is to make 10 times my money, meaning I want to convert my 500,000 into 5 million. So that's what VCs want. They want a 10 times return. So they want to put in 500,000, they want to get out 5 million. What that means for the entrepreneur is that for the VCs to get a 5 million return, the business needs to sell. Like you need to exit the business, or the value of the business needs to grow to at least 25 million pounds. Why? Because 5 million is 20% of 25 million. Just stay with me here for a bit. I don't want you to get lost in the numbers. Ultimately, they own 20% of the business. They want to get 5 million at the end of the day. It is only possible for them to get 5 million if you sell the business for 25 million. So the question is, what are the conditions that are going to be required for selling a business for 25 million? Well, that business needs to be doing at least 2.5 million in revenue. That is assuming that the value of a business is 10 times the profit. So you need to be doing 2.5 million in profits. What is it going to take for a business to do 2.5 million in profits? At least, you should be doing 10 million in revenue on a yearly basis. So when a venture capital firm is evaluating your business for investment and they're thinking about the opportunity, you go to them and say, oh, we want 500,000 pounds. We're going to attack this market. We're going to do really well. In their mind, the question they're asking themselves is, can this business actually get to like 10 million in revenue a year? Is the market big enough? Do they have enough? Is this opportunity large enough? Is the market timing right? Are there enough verticals? Is their pricing right enough? For example, it is going to take a lot of work for a £20 a month business to get to 10 million in revenue. If you work out the numbers, you see that you have to acquire a critical mass of customers. So investors are thinking about this at the back end, because if the opportunity is not sizable, it's not worth it for them. So when you are trying to get your business investable, you need to first of all think about, okay, great. Is our business model right? Yes, that is good. We have a viable business. But also the opportunity that we're attacking and try to take advantage of, is it big enough? And then when you satisfy that, then the last thing there around the investability bot, like I call it, is our team backable? And the whole idea of a backable team is to make sure that within your business, you have all the competencies that you need, at least on a high level. Now, so every business needs two broad-based competencies. every single business, regardless of industry. There are commercial competencies and there are technical competencies. Commercial competencies are the things that enable you to sell, to market, to get customers, to make money. Technical competencies are the things that enable you to build the product, serve the customer, create the innovations. So whatever, if you're an accountant business, you need to have people who know how to do the technical accounting work, and you need to know somebody that knows how to sell. You need to have somebody that knows how to sell to customers. If you are a business that manufacture hardware equipment that is used in military contracting, as an example, you need to have the technology to be able to build the equipment, and you need to have somebody who is able to get the deals, right? Every business has got commercial and technical competencies. The first thing you want to do within your team is present to an investor that you've got all the competencies that you need to actually make the business run. Somebody is asking me so silently, what if I am a one-man business? Well, if you're a one-man business, surround yourself with people that have the competencies that you don't. It could be advisors, it could be part-time team members, it could be, professional help that you can get. But when investors look at a business, they look at the team makeup, because they're literally asking themselves, these are going to be the people responsible for our money. Do we trust that they have the expertise, the knowledge, the experience, the maturity, the technical know-how, the stewardship to be able to steward our money? The team is a very important component. I know that I'm going into details of these things, and it doesn't seem like I'm telling you, oh, go here to get money, go there to get money. But you can go everywhere to get money that you want. If you don't fix these things, it's just going to be a plethora of no's. I want you to get in front of an investor or funder and go, this is what we're looking to accomplish. This is who we are. This is what we've built. This is where we're headed. And we believe that partnering with you will help us get there faster. Come along this journey with us. And they go, we really like this. Let's have a deeper conversation. That's what I'm shooting for. That's what I'm hoping for you. Right? All right. So now let's get into the technicalities of things. So how do you then, I mean, once you've satisfied the fact that, okay, first of all, we have a clear objective. That's the path. Secondly, we have a business that is sizable and effective and works really well. Then the question is, what is the next thing? Well, the next thing is to set up the fundraise. By the way, before I go ahead, I should mention, if you've got any questions, please feel free to write them down. I'm going to make sure that I take a strategic pause somewhere in the middle or maybe at the end where you can ask all your questions. So you can either put them in the chat or write them in your notepad, and you would have an opportunity to ask questions. And please, when you're asking questions, I want you to try to make it as contextualized to you as possible, because that's the way that you can get the most value out of it. So anyways, back to the slides. So let's talk about this fundraising strategy. Now, under fundraising strategy, there are so many things to consider. First is, what type of capital are we even raising? We've talked about funding, capital. But the question is, what type of capital are we raising? The second question is, how much money are we asking for? The third question is, who are we asking the money from? Who are we approaching for the money, right? The next question is, what valuation, especially if it's equity, what valuation or at what interest rate are we able to take this money if it's debt? And then what is the story that we're presenting? What is the narrative? These are things that you have to deal with on the strategy. Now, for the sake of time, I am going to cover the first two. We cannot get into the rest. I mean, we can have a full masterclass just on valuation alone, as an example. Story and crafting your pitch story and how to pitch, that in itself is a different session. So I'm going to focus on the first two, because once you understand the first two, you already have the foundations that you need to actually begin to approach fundraising. So let's get into the very first one, which is, what type of capital should I actually be raising? And there's actually going to be an exercise at the end of this, which I'm actually quite excited for you guys about. If you're going to be raising capital, you have a clear objective, you have an investable business. The next thing you must figure out is, what is the type of money that I should be getting? Because if you do not know, there are three types of money. But before I get into that, let's first talk about the different dimensions that money can come from. Money is either internal or external. Internal capital comes from two places. The founder putting money into the business, that's internal capital, and the business generating profit to refinance its own operation. Remember that flow that I showed you earlier, where profit is going back into capital. That's the second way you can get internal capital. So internal capital is made up of founders' investment and retained earnings. That's what internal capital is. External capital is what we want to focus on today. I've already talked about internal capital. Now, with external capital, there are three types of money. There are only three types of money. If somebody gives you money for your business, it would either be a grant, debt, or equity. Equity is when somebody gives you money in exchange for um, shareholding in your business. Debt is when somebody gives you money in exchange for some interest. Now, when people give you debt, they expect you to fully pay back that money with or without interest. Grant is when people give you money because they feel like what you're doing helps them accomplish their own objective. That's what grants are, right? Grant is conditional money. Again, I'm going to talk in detail about these three types of money, but there's also something called crowdfunding. Crowdfunding is not a type of capital. It's just a different form, a different structure of raising the capital. Because when you crowdfund, you're either going to be crowdfunding for a grant, crowdfunding for debt, or crowdfunding for equity. But crowdfunding simply means, as opposed to getting the money from one person, you get the money from a lot of people. So, for example, as opposed to getting £100,000 from one investor, you got £100 from 1,000 people. That's what crowdfunding is. Let's dive a bit into the pros and cons of these different types of capital. The reason why for me this is important is because every entrepreneur must know the type of capital to raise, because if you raise the wrong type of capital, it will be detrimental to the business. Not it can be detrimental, it will be detrimental to the business. So when we're thinking about raising capital, it's important to know, when do I use what and what is appropriate for me? So let's take a look at grant. Grant is not free money. Like I said, it is conditional money. It is free money in the sense that you don't have to pay it back or whatnot. But ultimately, it's given to you because you meet certain conditions. So in what instance should you use grant? Or what grants do is they reduce the internal cost, right? Because there's no post-funding obligation. So these are the things that makes it very good. It's non-dilutive. It doesn't take equity away from you. If you're in the early stage of your business, it is most ideal in that scenario. Excuse me. However, um, you don't have any control over when the grant comes, right? Those are the cons of grants, right? You don't have any control over it when it comes, and it could have some stringent conditions. So, for example, it could require you to spend a whole lot of money that you don't have, so that you can then get some money back, right? And it doesn't always align perfectly with your plans because, again, um, grant is based on somebody else's conditions. So, for example, the local authority can say, we want to improve our energy efficiency across the area, right? And so we're going to give 30% of the cost of, so they say we want to reduce the energy consumption, we want to improve efficiency. So who can help us achieve that? Businesses. Oh, great. So this is what we're going to do. We'll say to businesses, if you swap out your energy consuming equipment with energy efficient ones, we would give you 50% of the cost of that transaction. That's an example. Now, you as the business in question had already been thinking about swapping out your machinery anyways, and then you go, wow, this is fantastic. We get 50% of the cost. Great. This is remarkable. But the only reason why that money is actually going out is because the government feels that by enabling you to do what you want to do, they will be achieving the broader objective. That's what grants are. So those broader objectives don't always fit with your own plans, as some of you already can identify, right? And it's not dependable. Grants are almost always a competitive process, right? There are no guarantees that you're going to get it. So the question is, if you are going to get grants, what are the things that enable you to get it? First of all, you must meet the primary criteria. You have to be able to apply for the grant, and you need to be able to put a cost to your project, because most grants will want to know what you're spending the money on. Generally speaking, that's how grants behave. How do debts behave as a type of capital? Well, it's a loan. You have to repay it with or without interest. If you're ever taking debt or loans, there are four things you need to primarily consider. How much is the money that we're taking? What is the interest rate? How much time do I have to pay it back? And what is the structure of repayment? If you understand these four things, then you would not be taken aback every time you go into a debt situation. Because principal determines how much money you're taking. Interest rate determines how much you would have to pay back at the end of the day, because that's how much interest is charged on your money. Time is how much time you're going to have to pay back the money. Debt is not patient. It's not a very patient type of capital. It's always looking to get out of your business the moment it gets in, right? And that's why repayment structure is also very important, because you need to understand what is the structure of giving back this money. Do I pay back just the interest for a while? Do I have a moratorium period? Do I have to pay back interest plus capital plus principal? I meant to say, so things of that nature are things to consider with debt. Now, what are the pros when it comes to debt? It's a very, very fast form of capital. It is always available. There is always debt available. Debt is available at every level. If you're looking for £1,000 debt, you can find it. If you're looking for £10 million debt, you can find it. It's always available. And it's cash flow friendly if you use it correctly. It can really, really help your cash flow. And at every stage of business, you can use debt. The cons, well, the terms can destroy a business if you do not pay careful attention, right? And like I mentioned earlier, it's not a patient type of capital. And because the return is demanded immediately, it can make your growth even more expensive. And ultimately, in most cases, you would require a track record of positive cash flow. Why would you require a track record of positive cash flow? It goes back to what investors care about. Investors want to make sure that their money is safe. And in the case of debt, how do they guarantee that their money is safe? Well, they take a look at your track record and see that, oh, money is coming in, so at least they can make the repayment. Debt providers want to make sure that you're able to make repayment. So what are the prerequisites for actually getting debt? Well, you need to have a track record of positive cash flow. There has to be a clear application and return plan. So a clear process of applying and paying back the money, and you need to be able to put together your financial projections and also your historical financials as well. I think the only debt that I know of that does not require the track record of positive cash flow as a requirement is the British Business Bank's startup loans. Startup loans don't require a track record of positive cash flow, because I've helped even startups, people that are just setting out, building out their ideas, successfully access startup loans. They don't have a track record. Startup loans are not going to ask you to bring your last 1 year bank statement or things of that nature. Anyways, then let's talk about equity. What are the nuances of equity? In equity, what you're doing essentially is you're selling part of the ownership of the business. That's what you're doing in essence. So you take in money from an investor and you give that investor part of the ownership of the business. Now, when you're selling equity, there are four things to consider as well. The shares that you're selling, what those shares are valued at, how much money you're asking for, and the terms of that money. Terms are a very precarious thing. We can't get into it today, but the terms under which you take in an equity investment could literally make or break your business. So these are things to consider. what we're going to focus on is how to determine the ask. We can't talk about the details of all the others, but generally speaking, you need to consider these four things. What are the pros of equity? Well, equity helps you when you're looking for a large amount of capital to grow your business. Now, equity, unlike debt, is very, very patient. When equity money comes into your business, it's not looking to jump out at the next opportunity. That money stays in your business, allows your business to utilize it, marinate on it, you know, leverage it as much as you can to actually achieve the growth that you're looking for. And also, when you take in equity, you also bring in co-builders, because the investors that are putting money into your business are also building alongside with you. They want your business to succeed. So they will, if you get the right type of investors, they will help you as best as they can. They would help you with information, with insight, with contacts, with introductions, because they want you to succeed. So that's the beauty of equity. It brings in co-builders. It also helps your business appreciate in value, right? Because until there's an equity transaction, there is no official valuation for most businesses. So you may have started this thing at zero, like you started from scratch, but now it's worth, say, £5 million in value. If you've never had an equity transaction, you cannot commercialize that. And then if you have an opportunity that is scalable, equity is always available to you. However, it's a long drawn process. It has multiple levels of things to consider. It takes a bit of time before it actually materializes. Obviously, they take equity in your business, so you're diluted a little bit. And it can become controlling if you don't get the terms right, right? And if you've got specific questions around this, by the way, please ask them during Q&A. So I know we can get into a lot of technicalities, but if you've got specific questions around technicalities, that's what the Q&As are for. So when you ask your question, I can speak specifically to those contexts. It could also alter the strategic direction of the business. So if you say you will want to go down this path and the investors say we want to go that path, then we have a clash of strategic direction, and it literally could be catastrophic for the business. To get equity, you've got to have a scalable opportunity, you have to have a clear strategy for raising capital, and you have to have the documents that you need. Crowdfunding is great if you've got a large community, essentially, because again, as the name suggests, success in crowdfunding depends on the crowd. So if you've got access to a large community, it enables you to actually successfully execute a crowdfunding campaign. It should be an extension of your value offering. What that means is the crowd are more likely to support what you're doing if you can show them, how it creates more level of impact, how it helps you do more and whatnot. And the thing about network effect is the more people support your cause, the more people want to support your cause. So network effect is a big thing in crowdfunding, and you can use it actually to complete a round. So for example, you're raising equity, you haven't gotten all the money, then you can do a crowdfunding round to actually complete it and whatnot. So this is the time to actually run a very quick exercise. If you scan this QR code, now this exercise is going to take 2 minutes, or it might take 3 minutes because we're in a workshop setting. So what I'm going to do is I'm going to stop sharing for a minute. Let's see. Just a second. So what I want to do, I'm going to come into the chat box. So I want to get into chat, and I'm going to put a URL in that chat. So you could copy that URL and click on it. So this is a practical exercise I want everybody to do. Now, what you're going to see when you click on that URL or when you scan QR code, I know I just stopped sharing. Let me go back to sharing my screen. Just a second. So just a second, let me get back to my screen. Okay, great. There we are. Now let's share that. So what you're going to see if you get on that QR code is you're going to answer 14 questions about where you are at as a business. And when you are done answering the 14 questions immediately, it is going to show you first of all, at the center, your funding fit score, which is how fit is your business today for funding. It's going to score you on a percentage. And then it's going to give you percentages as well in terms of how much of a fit your business is for equity, debt, grant, crowdfunding, and even self-funding. So if you fill out those 14 questions, and literally they're simple multiple choice questions, you select those questions, it will tell you what your business is best for. And please make sure that you put in your correct email addresses, because then it sends a PDF report to your emails about how fit your business is for funding. So I believe that you've had an opportunity to scan the QR code. I am going to leave it on the screen nonetheless, but also the link is in the chat. Please take the next 2-3 minutes to fill that out. And once you get to the results page and you've seen the results, just come into the chat and type results seen. Just type results seen. So that I could just keep track of where everybody's at. I expect that it's going to take it's pretty much going to be like a 2-3 minute exercise, but I just want to be able to keep track that we are actually getting this result. So, yep, I'm going to leave it at that. Everyone, we got 3 minutes to complete this exercise. In order to, let's see if, Lucy, could you confirm if you can hear the music playing at the background?
Not yet, no.
So I was just doing it. So every time I give an exercise in a workshop, I always like to put on background jazz music so that it just inspires people to work more. Let me see if that can work.
There we go.
Beautiful. So everyone, we got 3 minutes. And once you have your results, just type in the chat results. Sharon says your computer won't let you open. So Shannon, what you could do is copy that URL and just save it. And it's simple. It's novelapp.biz. So novelapp.biz. If you type that in, just save it somewhere, and you can do this exercise eventually, even when we're done from today's session. It is novelapp.biz. If you write that down, then you can do that much later as well. And this is a good opportunity to get a drink as well if you need to get a drink. Lucy, I hope you like my music choice.
Absolutely loving it, David. Yeah. It's very soothing.
Absolutely. Please remember, once you're done, just type into the chat results seen. I know that the temptation is just going to be to dive in straight and begin to read through, because yes, the result page provides you with analysis around why you scored that, what you scored across each of the types of capital. Fabulous, Rachel. Glad you've seen your result. Paul seen the result, which is really good. Interesting. Cool. So we've got 2 people that's seen the result. I think there are about 12-13 of us on the call. Actually about 14 of us on the call. So just make sure at least about 5, 6, 7 people have seen the result. And by the way, you can digest these results later. Also, the reason why you get them in your emails is so that you can take your time and take a look at them. But what that report essentially does, fabulous. Louis has seen the result. Chris has seen the result. Beautiful. So what I'm going to do very quickly is turn up the music so that I don't distract you. I don't lull you to sleep. Yeah, music stopped. Yeah, confirm, Lucy. Beautiful.
Yep, confirm. Yeah.
Yeah. So Very quickly, I'm going to stop sharing for a second. So very quickly, what you will see in that result is a breakdown of how fit the business is today for that each type of capital. And it will show you which one you are the biggest fit for and which one you are the lowest fit for. And the analysis that you've just gone through, the assessment you've just gone through is literally built on the fundamental parameters that the funders in each of those types of capital use to actually even entertain conversations, right? So for example, for equity providers want to make sure that we are funding a business that is already operating, because the job of equity funding is to blow up. It's like pouring petrol on a flame. If you've got a flame and you pour petrol on it, you get an explosion. If you have no flame and you just pour petrol, the petrol is going to fall to the ground and it's going to dry off. That's exactly what happens when you put investment into a business that is not, doesn't have that flame. It hasn't proven that it's viable. It doesn't have that investability. The other thing to mention as well as an example is if you've got a very large business community, you already have the makings of crowdfunding regardless, right? Because once you decide that you want to raise capital, then having access to a large community helps you to get the word out. And the larger your community, the larger the amplification that you will get for the results that you're looking for to enable you successfully raise capital. In any case, here's a summary. The summary is take your time after today's session, take a look at your report. I believe that, again, for maybe not for everybody, but in your PDF report, if you've got questions, and also don't worry, I'm going to share my email at the end. If you've got questions, even after today, and you've reviewed your report and certain things aren't clear to you, or you need a bit of guidance on whatnot, you can shoot me an email. I will be very, very happy to provide responses and guidance however necessary. So great. Now that you've got your funding fit report and the implementations and suggested recommendations of how you can make it better, let us get back to our slides to continue to touch on the other areas of today's conversation, because we still have a bit to go. Okay, I'm mindful of time. We will be right on time and we're going to have enough time for questions. Okay, great. So that is done. Please, can you confirm that you can see my screen now again? Oh, beautiful.
Yeah.
Fabulous. So now the next thing I want us to talk about, again, we're still talking about the strategy. We've talked about, first of all, the different types of capital that is available. Every entrepreneur must know the type of capital to raise. One of the things I didn't mention is this: what you need the money for will determine the type of capital that you go for. So, for example, you don't use long-term capital, which is equity, for short-term needs. So you don't go, our customers have delayed payment, so we don't have enough money to pay our bills for the end of this month. Let's look for an investor. That's not what you do. You don't also use short-term capital to fund long-term needs. What that means, as an example, is you don't go, we need to develop this new innovation. So we need to do a bit of research, experimentation, testing, and whatnot. But we need funding for all of this. So let's go borrow money that we have to pay back in 2 years, or that we have to start paying back next month. That's short-term capital. You don't use short-term capital for long-term needs. You don't use long-term capital for short-term needs. If you ever do that, it's a recipe for disaster. So every type of capital has its own nuance to use. So what type of capital you decide to go for will be dependent on the thing that you're looking to accomplish within your business. So now let's talk about how to determine how much you're looking for. The ask that you make of an investor or of a funder does not work in isolation. It is based on how much resources you need to execute your growth strategy. Remember, when we talked about the growth strategy, we talked about execution plan and the execution budget. So, what are the resources that you need to execute? But also, it's a two-way street. It's not just about what you need, it's also about the value that the investor sees in your business, which is the reason why valuation is such a big thing. But we're not talking about valuation today. If you want to determine the ask, there are three major things that make up how much money you ask for. I decided to share on this because it's one of the things that a lot of entrepreneurs, one of the most commonly asked questions in fundraising, how much should I ask an investor for? And a lot of entrepreneurs just don't know. This is how you figure out how much to ask an investor for. There are three steps to it. So step number one is you do your execution budget and you figure out how much it's going to cost you to implement your execution plan that will deliver the growth objective. I've talked enough about that already today. But that's your execution budget is not the know all and be all of your ask. So, for example, if your execution budget is £130,000 to execute your 3-year growth objective, it doesn't mean you go to an investor and say, "Oh, give us £130,000." There's a second consideration. The second consideration is cash flow shortfalls. Let me explain what that means. So once you decide that you want to raise capital and you figure out the execution budget, the next thing you then do is create your financial model. So your financial model is they also call it financial projections or forecast or what have you. But essentially, it is the financial implication of you executing that strategy. Why is it important that you plot your financial model? Because when you do, you will identify months where you are going to have losses. So, for example, it is very common that when businesses raise capital, they're implementing a growth plan. The growth plan itself takes a bit of time to materialize into revenues. So, in the first few months, you're making losses. Well, losses mean you spent more money than you had. That money has to come from somewhere. Because if you don't have it, you can't spend it. So if you're projecting that you're going to make losses for certain months across your 3-year timeline, you need to take all of those losses, aggregate them, and make financial provision for them. That financial provision is what we refer to as your cash flow shortfalls. So when you do your projections and you see the shortfalls in your cash flow, you need to take that into consideration for your ask. So it's going to cost us 130,000 to execute our growth strategy. All of the losses that we have seen is about 40,000. So we'll also build that into the ask, meaning we're now going to be asking for 130 plus 40. So now we're asking for 170. But wait, there is more. Anybody that has ever run business before knows that once the rubber hits the road, things almost always never go as planned, right? Things happen, unforeseen circumstances, market changes, regulatory changes, government changes, and you need to be able to adapt as a business on the go. So you don't want a change happening in the external environment that literally disrupts your plans, and then you have to go back to the investors saying we need more money because this happened. You want to make sure that you at least create a little bit of cushion to cover for any eventualities. And that's what we refer to as your reality cushion. So, for example, execution budget 130, cash flow shortfalls 40,000. That brings me to 170. The nearest ballpark to that is 200,000 pounds. So I could put in a 30,000 pound cushion and say, I am raising 200,000 pounds. Every time you're thinking about how much to ask an investor for, that is the process. It's as simple as that. What is the execution budget? What are the shortfalls in our cash flow? And what cushion do we want to build into this? Has that helped anybody? If that has been very helpful, just type in helpful into the chat. That would be helpful to me because I can see my screen. I can't really see all of you. So just type in helpful into the chat. That would be really cool. Anyways, the other thing to mention is your ask must be tied to a milestone and timeline. So milestone is the growth objective I was explaining to you earlier. Timeline is how long it's going to take to deliver, which I'd explained earlier as well. So these things all work together. That's the strategy. On the strategy, we've talked about the type of capital and how to determine your ask. Like I said, all the other things we can get into. I mean, um, there's still tools and execution I want to talk about before we get into Q&A, and we only have about a few minutes to do that. So let's get into tools. Now, what do I refer to as tools or your tool set? Once you've figured out the path to growth, you have validated that your business is an investable asset. You have set up the strategy to actually raise capital, meaning you know the exact type of capital you're looking for, you know how much you're asking for, and then you've worked out all the other details. Then the question is, what tools are you going to need to actually approach investors with? Well, there's so many tools. For example, we have your financials, you have your pitch deck, you have your teaser pitch, you have your strategic plan, you have your due diligence readiness. There's so many things that are covered on here. For today's conversation, I'm going to focus on two very popular ones: financials and your pitch deck. In If you're raising debt, you're going to need financials. If you're raising grants, you're going to need financials. If you're raising equity, you're going to need financials. If you're raising equity, you're going to need pitch deck. If you're raising grants, in many instances, you're going to need pitch deck. If you're raising debt, you may or may not need pitch deck, but it is very essential. So I'm going to talk about these two things as briefly as I can, but without skimping on very important details. So let's go straight into it. What is the purpose of your financials? We start with financials. The purpose of your financial is to prove the VES test to an investor. What is the VES test? Is to show that number one, your business is viable. Number two, your business is running efficiently. And number three, your business can scale. Every investor needs to understand these three things in sequence. Viable means it works, it makes money. Efficient means it is operating well enough that it's able to be profitable, not just generate revenue. Because revenue is good, but we also want to make sure that it's profitable. Then scalable means that this thing can actually grow exponentially. So when you're putting together a financial model, it needs to show your money model, meaning how the business makes money. It needs to show your operating model, meaning how you run your business. So what is your operating model? Is it a retail setup? Is it a software as a service setup? Is it a manufacturing setup? Is it a services business type of setup? That needs to be reflected in your financial model, and it also needs to show the things that are driving growth. In some businesses, the drivers of growth is customer acquisition, which actually is in most businesses. In some businesses, it's opening up new market. In some businesses, it is innovation. There's so many different things that some businesses, regulation is what drives growth in their business. But whatever it is in your business, it needs to be reflected in your financials. So what is the golden principle when it comes to putting together a set of financials for fundraising? For me, it is that your financial is driver based. Now, oftentimes what I see entrepreneurs do is you want to raise capital, you want to do financials, you go online and you type in financials template or cash flow template or something of that nature. And there are lots of templates online. Whatever template you're using, whatever tool you're using, or even if you're building one yourself, which is what I always recommend, or you have your accountant build one for you, what you need to make sure of is that it is driver based. What do I mean by that? Let's explain what I mean by drivers by going into the fundamental nature of money. Money only flows in two directions. Anybody wants to guess what two directions those are? Everybody knows. It comes in and it goes out. Now, when money comes into your business, there are three things that are responsible for it. When money goes out in your business, it goes out in three different channels. When money comes in, the three things responsible for money coming in is the value that you create. So that's your product or your service. How much you charge for it, which is your price, and how many of it you sell. Excuse me. So, for example, if you sell a product for £1,000 and you generated £10,000 in sale, the only reason why you got £10,000 to come in is that you had something that people valued. They were willing to pay £1,000 for it, and 10 people got it. These three things here are the things collectively that determine how much money comes into your business. So if you want to engineer more money coming in, these are the three things to worry about. When money goes out in a business, it would either go out as direct cost, which is cost that is directly incidental to what you sell. So the cost of creating your service or creating your product or buying what you sell. Or it would go out as operating cost, which is cost of running the business. Or it would go out as sunk cost and investment. So these are costs that you have to spend one time in order to be able to run your business. So think of things like investing in software, right? You spend on it one time and then you have it. Buying an equipment, you spend on it one time and now you have it. Operating costs are sort of like recurring type of cost. You have to pay rent on a monthly basis and whatnot. Direct costs are the cost of your operations. Why am I explaining this? I want to show you what a driver-based model is. Now, if these are the 6 things that are responsible for the inflow and outflow of money, this is your product. Well, so that's your given anyways. So ultimately, there are price, volume, direct cost, operating cost, and sunk cost. These are the 5 things. These 3 things are responsible for money going out. These 2 things, plus your product, is responsible for money coming in. This is what I want you to pay attention to. The direct cost of your business is very easy to determine, because everybody here, I would presume, knows what it costs to get the materials that goes into their product, or you know how many hours typically it would take you to provide a service, or you know what your product costs when you get it from the supplier and how much you sell it to the customer. Direct cost is very determinable. Your operating cost is easily determinable because it's a monthly thing. So you have a fair idea of how much rent you have to pay on a monthly basis. The investments you need to make are easily determinable because that simply comes down to the choices and the decisions you've made. So if you have said um, we need to start making content, as a result, we need to buy a piece of camera, right? It's easy. Just go look for the cost of cameras. The price at which you sell your product is very determinable. The one that always shifts, the volatile one, the one that is extremely variable, is volume. Ladies and gentlemen, please pay attention to this. Regardless of the complexity of your financial model or whoever it is that did your financials for you, your financials literally are a combination of these 5 factors. And of the 5 factors, 4 of them are very easy to determine, meaning that nobody is really going to argue with you based on some of these things because they are very easy to determine. There is basis for them. You can literally provide your past account and we can see your direct cost. We can see your operating cost. We can see, when you present your growth plan, we can see what investments you want to make. We know the price of your product. These things are easy. When you design your financial model, a driver-based model is a model that literally provides a detailed breakdown of how volume will grow, because volume is what drives growth. So the crucial question you need to emphasize in your financial model to an investor is, what is the thing that is driving volume growth? What are the things we're going to do that will make more people come buy this? What are the things that we're going to do that will get more people excited about what we're doing? And how is that going to translate into sales? How is that going to translate into more revenue? Your financial model needs to explicitly explain that. The reason why I'm emphasizing this is because oftentimes this very thing, this most important factor, is the one that we very conveniently just use an assumption on. So people just say something like, we assume that we are going to grow 5% month on month without basis. And that doesn't help anybody because the most important factor is what you've assumed. You need to show a rigorous breakdown of how this works. For example, we will spend £3,000 a month in Facebook advertising. We have shown historically that we have a 10% conversion rate, and £3,000 a month will get us access to 100 customers. At the 10% conversion rate, it means that if we spend 3,000, we'll get 10 people to buy. 10 people buying at 2,500 a month means that on a monthly basis, we will generate 25,000 in revenue. That is a breakdown of you understanding the engine of growth, how you would engineer volume. So you know then that if you spend £3,000 to get 1,000 people to see what you're doing, if you spend £6,000, you're probably going to get 2,000 or more. That's what investors want to see. That kind of granularity. That's what they're looking for. A few more things to talk about around financials. When you're putting your financial model together, you must have the historical data, literally what you've done in the past in there. You should have the drivers and conversions, which is what I just explained. So what are the things that are driving your growth, and what is the conversion rate of attention into customers? You need to have the clear interdependencies. So for example, if we go from selling 2 items a month to 20 items a month, how many more employees do we need to have? So there are so many interdependencies within a business. For example, in order for you to service 50 more clients, you need to hire 2 more employees, because on average, 1 employee caters to 25 clients. That's an example of an interdependency. And then you need to have the right template if you're using a template. That's it about financial models. Very quickly, let's talk about pitch deck, and then we can talk about the final steps and then get into questions. So pitch decks essentially are these visual documents similar to what I'm presenting to you today that conveys your proposition to an investor. Now, your pitch deck must get an investor to open it, read it, comprehend it, be informed about what you're doing, and make a yes or no decision as to whether or not they want to have a conversation with you. The investor doesn't take a look at your pitch deck and decide whether or not they want to invest. Because even with the best laid out pitch deck, people are not just going to say, wow, what a beautiful pitch deck. Here's the money you're asking for. The pitch deck just makes them go, this is a really good proposition. He has the right problem. He has this, he has that, he has that. Now, I want to dig deeper. Let's have a conversation with this founder. That's what tends to happen, right? So how do you make your pitch deck compelling? Well, there are 5 things that guides the development process of a pitch deck. The first thing you must do is, who is the audience, right? Having clarity around who the audience is, who the investor is, would determine what slides go into your pitch deck in the first instance, because a pitch deck is a piece of communication, right? If I know exactly what an investor is looking for, so for example, if I'm pitching to an investor that says, we as an investment firm are designed to help promote and to give great market opportunities to businesses that are developed in Cumbria, right? That's the investment thesis. Well, knowing that that is the mission of that investment firm, I will literally start my deck with, as a Cumbria-based business, or as a business that is, do you get my point? What you know of the audience will determine what you put into your slides. See, there is no shortage of people out there that say things like, your pitch deck must start with problem. Your pitch deck must start with... I say your pitch deck can start with anything. And I've seen this in practice. It just depends on who is the audience and what story do you want to tell them. Because the story, which is the second pillar, is what determines the sequence of the slide. So for example, if I wanted to tell a story of opportunity, right? I can start my first slide after my title page. I can start with, across the United Kingdom, 30 billion pound is spent on a daily basis on X. However, of that 30 billion, there is a segment of it which is X that nobody's catering to. That is starting my narrative with an opportunity. And then I go, our business is this for this type of customer. And then I can go that way. That's a story of opportunity. I could tell a hero story, which is, there is this terrible situation. It is bad. Nobody's paying attention to it. We have developed a unique solution that will solve that problem. And when the customers use it, they'll live happily ever after. The reason why this story matters is because that's what determines what slide comes first, what slide goes next. The next thing then is you have to consider is, what channel am I going to be transmitting this pitch deck through? So is this something I'm going to have to send via email, or is this something I'm going to have to present physically? Why does this matter, you might ask me? It matters because of the depth of the content. Remember, the job of a pitch deck is that people can very quickly go through it in about 1 minute or 2 and have a very good understanding of your investment proposition. So you don't want to make it a business plan. You don't want to make it an investment. You don't want to make it a thesis or an academic paper. If it's something you're presenting, people need to be able to consume the information on the screen in a fraction of a second. If it's something that is going to go via email, so let's just take a typical example. Look at the slide on your screen right now. How many words are there on the slides beside my name at the top? You've got channel and you've got depth, 2 words. But because I am presenting it and my voice is accompanying it, you have an understanding of what I'm trying to explain on the slide. If I sent this slide to you via email, you would not understand what the slide means. So when you're sending a pitch deck via email, it needs to have just about enough words to convey meaning about the point you're trying to make, but not too much words that it feels like a document that I have to come back to read. But if you're presenting, you don't even have to have a lot of words. That's why channels are very important. Understanding the channels through which you transmit the deck would help you structure the deck correctly. And then, what is the purpose of the deck? Is this an introductory deck to an investor, or is this, a follow-on deck for investment? So an introductory deck could literally have about 10 to 12 slides that introduce your business. An investment deck could have about 18 to 30 slides that talks about different details around your business, because at that point, what the investors are looking for is more detail. And then the last thing you consider is the design. If you consider the audience, the story, the channel, the purpose, then you can then begin to design it and make it look pretty and whatnot. Now, this section will not be complete if I do not give you at least a standard structure for what your pitch deck should look like. Now, why do I call this a standard structure? Because, and by the way, first rule is feel free to ignore the structure in your pitch deck if this is not what your audience is looking for. You know the investors. If this does not align with them, then don't use this structure. But why does this structure matter? Because it has everything an investor is looking for to make a yes or no decision. Because this is how you present this. This is the problem we're solving. This is the solution that we believe will solve that problem. This is the product we've developed to solve that problem, and this is the customers that we're targeting. This is how large we believe that market is, and these are the other players in that market. This is how far we have come since we started, and this is how we are making money. This is how much money we believe we're going to make in future. These are the people responsible for making this business happen. This is how much we're asking for. We believe you should invest in us today because it is going to make everybody live happily ever after. That's the pitch. It has, in that singular flow, everything an investor needs to make a decision, and it's a narrative that flows, right? I can't get into the details of each and every one of these, but I've singled out 3 slides to talk about. On the problem slide, you want to dig beyond the surface. Do not present the problem your business is solving. Do not present a societal problem as a business your business is solving. So, for example, do not say 3% of the UK population live under the poverty line. Even the government is still struggling to grapple with that problem. Your business cannot solve that problem. However, what you can do is use things like that to set the scene and set the tone. Ultimately, when I say dig beyond the surface, what I'm saying is when you're talking about your problem, you want to emphasize to the audience or to the investor, this is why customers are paying us. The reason why customers are choosing you over the alternative, that's the problem you're solving, right? Let's get into the next one. The market. When you're talking about the market slide, it is very important that you present the size of the market. There's something called the TAM SAM sum. I can't get into the details, unfortunately, because of time. TAM is total addressable market. SAM is serviceable addressable market. SOM is serviceable obtainable market. These are terminologies that explain to an investor different things about the market that you're serving. You need to be able to illustrate that. And then you've got traction, which is what you're talking about, what you've achieved thus far. This is a very important piece of your pitch deck because this is what gives you credibility. If you go to an investor saying we have an idea, they are more likely going to ignore you, because when you have an idea, there are some concrete steps you can take to begin to bring it to life before you ever need money. So if you're not presenting those concrete steps, say for example, we have designed the product, or we have built a team, or we have done research, or this is the data that we have, or whatnot, things of that nature, all of those count as traction. However, I should mention the ultimate type of traction is sales. If you can tell them that we have already sold and we have sales, then that already gives you like a lot of credibility traction wise, because sales just tells me they've already figured something out. Customers are buying it. They like the product. So there's definitely something here. All right. So let's get into the last bit. Once you've done all of these things, clear path, investable business, clear strategy, you have all the documents that you need. How do you go about the fundraise? Well, the first step is put together that strategy like we've talked about, right? It has to be well researched. It has to be real. The second step is then cleaning up your historical accounts. So if you've been trading for a while, make sure that you have financials for each of the years clearly spelled out, because that gives an investor a very clear idea of what you had prioritized in the past, right? And then the next thing then is you work out your projections. Now, the projections, which we've talked about today, is like the financial implication of your strategy, of your growth. So when you've executed that growth, what is it going to look like numbers wise? That's what your projections are. Then you design your pitch deck. So if you want to follow this sequence, and by the way, you're going to get the slides as well. I should mention that. I'm going to make sure that these slides are sent across to you. Now, for those of you who've taken that funding fit assessment, I should have your email, so I will send you the slides directly. So you design your pitch deck, and then step 5 is design what we call a teaser pitch. A teaser pitch is a one-page pitch deck that literally talks about introduces your business. So it's a tool that you use if you're ever doing cold investor outreach, which is a thing as well. Then you do due diligence readiness. Now, most investment deals fall through, they fail at the due diligence phase. Due diligence essentially is investors coming through your business to find to find credible data or information that backs up all the claims you've made. So, for example, if you had said to investors, we have £30,000 in sales, show us the receipts, right? If you say we have a patent, well, show us the certificate, right? Things of that nature. That's what you do in due diligence. And then once you've done due diligence and you've done all of that, then you want to perfect how you design, how you pitch your business. So the pitch story, you want to talk about how you are running the business, what you're heading towards, what the timeline is, and things of that nature. There's so many things. Again, I run pitching masterclasses in itself that gets into both the technicality of the content and the practicality of the delivery. So again, we can get into that some other time, hopefully. And then once you've done all of that, then it then becomes a cycle of building relationships with funders, delivering pitches at the right opportunity, listening for feedback, making changes where necessary, and going again. Even with the best laid out opportunities, it is still a journey of finding the right partner, the right investor. So you would pitch to some investors that you think are the right investors. They will come back to you saying, because of this reason or that reason, it's not the right thing for us at the minute. So it's a repetitive process of building relationships, pitching, listening, tweaking, and going again. And ultimately, if you need help, there's an abundance of help available. Again, we do a lot of work with businesses that are looking to raise capital. There is the accelerator that Lucy talked about earlier that can help you develop some of the different parts of your business, whether it is your plan, your strategy, your financials. You have experts and advisors who can help you look at these things and optimize it. But ultimately, above all else, this is where I want to end the conversation today. Even as you go through this journey of raising capital, never stop building your business, because ultimately the capital is to help you grow the business. So you cannot sacrifice the growth of the business on the altar of raising capital. So keep putting one foot in front of the other, and eventually you're going to get the results that you want, because progress gets attention. If you went to an investor in January and they said no, if you went back in February and told them, oh, last month we're doing £2,000 in sales, now we're doing £7,000 in sales, it gets the attention because progress always gets attention. I hope that has been very helpful today, ladies and gentlemen. If you've got questions, I will be glad to take them. That QR code on the screen takes you to my LinkedIn page, but I'm gonna so if you want to connect with me on LinkedIn, I am going to copy my URL and I am going to put that in the chat as well. But thank you very much, everybody. I'm so sorry. I planned for us to have 15 minutes of Q&A, but now it's 5 minutes before time.